Okay, let's unpack this.
Let's do it.
This is, I think, the single biggest play we've seen in the mid-tier IT space all year.
Oh, easily.
Coforge just went all in with a massive $2.35 billion deal to acquire Encore.
And that price tag alone, I mean, it tells you everything about the desperate search for high-end AI talent right now.
It's more than just a big acquisition, though, isn't it? This feels like a defining moment for them.
It is. It's a defining moment for Coforge and, frankly, for the whole sector. They are betting their immediate financial health on this massive leap in capability.
So this move just completely redefines their scale, their mission for the next, decade?
Exactly. And when you say massive, we need to be clear about what that means.
Right. We're looking at an enterprise value of $2.35 billion.
Which, for context, is about 21,138 crore rupees.
That's what they're paying for a US-based digital engineering and AI specialist. For a company of Coforge's size, that is?
Right.
Well, it's a breathtaking number.
And that's our mission for this deep dive, really, to analyze the tension inside that number.
Okay, so we'll dissect the financial mechanics.
Especially that high-stakes financing structure.
Yeah.
And then we have to understand the strategic necessity that forced them to pay such a high premium.
And of course, the immediate market reaction, the anxiety around the dilution and all that new debt.
It's a classic high-risk, high-reward story. You absolutely need to understand both sides.
So let's start with the basics, the anatomy of the deal.
Simple enough. Coforge Limited, the Indian IT firm, is acquiring Encore.
And Encore's specialty is pure play AI and modern software engineering.
Right. And we have to emphasize that scale again. At $2.35 billion, this is the largest acquisition ever by an Indian IT services company.
It surpasses the old record, didn't it? The HCL one from a few years back.
It does. It blows past the record HCL set in 2018. This is Coforge trying to move from the mid-tier to the big leagues, overnight.
And Encore is a pretty substantial target on its own. They did, $516 million in turnover last fiscal year?
That's right, FY25. So that $2.35 billion price tag means Coforge is paying almost 5 times Encore's annual revenue.
That multiple really tells you something about the quality of the asset they think they're chasing.
It absolutely does. But paying for it, well, that's where things get complicated. The financing is hybrid.
But it's really heavily weighted towards equity, which is where that investor fear about dilution comes from.
Yes. So let's break down the two main parts. First up is the equity swap.
Go ahead.
So $1.89 billion of the value is being paid through a preferential allotment of new equity shares.
So, new stock, about 17,000 crore rupees worth.
And here's an interesting wrinkle. They're issuing those shares at 1,815 rupees per share.
Which was an 8.5% premium over the stock's closing price before the deal.
Wait, hold on. Let's pause there because that's a huge point of tension.
You mean because the stock was already under pressure?
Exactly. The stock had dropped 7% in the 2 days leading up to the announcement, so the market was pushing the price down.
And they still paid an 8.5% premium on top of that for the share swap.
It's a massive contradiction. It feels like they're paying a premium on a valuation the market was actively rejecting.
So what's the logic there?
Well, it suggests they needed to make sure the sellers, the private equity firms, Advent International and Warburg Pincus, felt they were getting a good deal.
Right, because they aren't getting cash, they're getting stock.
A huge slice of Coforge, in fact. This share swap means those PE firms will now hold roughly 20% of Coforge's equity.
And they get 2 board seats?
And 2 board seats. They become very invested long-term shareholders.
So, okay, the good news is the PE firms are now aligned with Coforge's future. The bad news for existing shareholders is a massive 20% dilution.
Right out of the gate. It's a huge shift in the ownership structure.
And that's just part one of the financing.
Exactly.
Yeah.
The second half is debt.
Yeah.
Coforge has to deal with Encore's existing term loan.
And to do that, they're planning a bridge loan or a QIP.
A qualified institutional placement, up to $550 million, or about 5,000 crore rupees, specifically to retire that debt.
For listeners who maybe don't follow capital markets every day, what exactly is a QIP? Why does it matter here?
A QIP is just a fast-track way for a listed company to sell a big chunk of stock directly to institutional buyers. Think mutual funds, big insurance companies.
So it's faster than a full public offering?
Much faster. It's a mechanism for rapid fundraising, but it's just another path to more dilution.
And that timeline is going to be crucial. They expect the deal to close in, what, 4 to 6 months?
4 to 6 months, yeah, pending all the regulatory approvals from the RBI and U.S. authorities.
Which gives them a very tight 6-month window to get this QIP done without absolutely crushing the stock price.
And that window is going to be incredibly volatile because this whole high-stakes move is layered on top of an already shaky financial foundation.
Let's pivot to that, the historical context. Because this investor anxiety, it didn't just pop up out of nowhere.
Not at all. It was already boiling. Like you said, shares were down nearly 7% just before the deal, and year to date, the stock was off by over 10%.
So investors were nervous even before they knew about the $2.35 billion price tag.
The nervousness was really rooted in the fundamentals. I mean, if you looked at the balance sheet, Coforge had negligible cash reserves, just about nothing.
And their cash conversion guidance was weak compared to their peers.
The weakest, some would say. Which brings us to that infamous FCF to PAT ratio.
Right.
There were serious doubts they could maintain their guidance of a 70% free cash flow to profit after tax ratio.
And for the listener, that ratio is so important because it shows how well a company turns its reported profit into actual usable cash in the bank.
And if that ratio is weak, it means your profits are all tied up. They're not liquid, which makes taking on a big chunk of debt extremely risky.
So the CEO's growth story has been running way ahead of the company's balance sheet.
It's aggressive for sure. And this isn't the first time. This is their second major fundraise in just 18 months.
Right. They did that big QIP for the Signity Technologies acquisition before.
Exactly. So that history just fueled the anxiety. If they needed a massive QIP for that deal, what's this new, much larger deal going to do to the stock?
Yet, despite all these headwinds, the CEO, Sudhir Singh, has been just wildly bullish.
Wildly bullish is the perfect way to describe it. He was targeting a $2 billion revenue run rate as, imminent.
He even said he'd be really disappointed if they only hit $2 billion in FY27.
That kind of talk requires a huge move to back it up, especially when your rivals are struggling to land big deals.
To be fair, their momentum was real. They did land that massive 13-year contract from Sabre Corp.
A $1.56 billion deal. It showed they can win. But this acquisition, this is something else. It's a complete doubling down.
It removes all pretense of caution.
Which is why the strategic angle is so fascinating here.
What's fascinating here is
the sheer strategic necessity that forced them to pay this price, to just blow up their balance sheet constraints, their buying capability and scale right now to hit those growth targets.
In post-merger, this creates a $2.5 billion tech services powerhouse.
With a very clear vision. They are explicitly targeting $2 billion in revenue just from AI-led engineering, cloud, and data services by FY27.
They want to be an AI company.
That $2 billion AI services target is the clearest signal in this entire deal. They paid a premium for pure-play AI assets because those assets are incredibly scarce. Encore is the linchpin.
And Encore brings deep expertise with digital native companies and those crucial Fortune 1000 clients.
Plus 9,200 employees and a huge geographical advantage with that strong Latin American nearshore delivery base.
Over 3,000 engineers there. Nearshore capacity is like gold right now for serving the U.S. market.
And it's not just a talent buy, it's an IP buy. Encore has this proprietary AI platform called AIVATM.
Okay, so what makes AIVATM a game changer? Is it more than just another internal tool?
It seems to be. It's a ready-made framework that lets clients quickly combine different specialized AI services and data sources. So it gives Coforge an immediate product differentiator, a scalable platform, not just a bunch of smart people.
It accelerates time to market.
Precisely. And the CEO's rationale really underlined this. He said Encore's leaders had previously walked away from big deals because they lacked scale in foundational areas.
Like business process services, quality engineering, that kind of thing.
But the things Coforge can provide immediately. This is about creating an end-to-end transformation partner, from AI consulting all the way to back-office support.
The strategic upside seems clear, but we have to come back to the cost. Analysts are all saying this valuation is steeply priced.
Or financially demanding. Let's put a number on that cost. The purchase multiple is over 21 times Encore's adjusted EBITDA.
21 times. I mean, that's a multiple you usually see for pure SaaS companies with crazy recurring revenue.
Not for a traditional IT services firm, no. They are paying an unprecedented price for this level of engineering talent.
It's also nearly 4 times their estimated FY26 revenue, so how do they justify it?
Management is insisting the deal will not be EPS dilutive.
Based on Encore's strong margin profile and synergies they expect to find.
Right. Their combined EBIT margin target is 14% after you account for amortization.
But the brokerages are very cautious.
Extremely cautious. They're giving it a cautious thumbs up. They're saying EPS neutrality is completely dependent on hitting margins over 15% by FY27 and a perfect integration.
They like the ambition, but are terrified of the price and the risk.
And the risks are profound. You have the 21% equity dilution, the $550 million in new debt, and the huge cross-border integration risk.
Merging a U.S. digital native culture with a large Indian IT firm is complex.
Very. And analysts think that execution risk is being seriously undervalued by management right now. It's a bold financial tightrope walk.
Okay, let's pivot now to our dedicated segment. And remember, everyone listening, this is not financial advice.
We are not investment advisors. This is purely a thought exercise to help you dissect the logic behind a really controversial market move.
This is our outrageous but plausible contrarian trade idea.
Pitched against the prevailing market sentiment.
So the market has reacted, well, violently to the short-term news. Dilution, debt, the stock is down.
Our trade rationale says we ignore that volatility. Focus purely on the strategic premium paid for those scarce AI capabilities.
The pitch is this. We go long Coforge shares, right now.
The entry point is this temporary dilution-driven correction. We are betting that the CEO, who made Coforge India's fastest-growing IT company before this deal, is going to achieve synergies way faster than the market expects.
So the core idea is that the premium, that 21 times EBITDA multiple, will be justified by the immediate success of the AIVATM platform and that FY27 $2 billion AI revenue target.
We view Coforge, post-deal, as an immediate AI services pure play. We think the market is severely overestimating the integration risk. They're forgetting Encore's PE sellers are now vested shareholders.
That's a powerful alignment.
It is. Our target would be the previous Nomura price target of 2,000 rupees. And the time frame for this has to extend past the 6-month QIP closing period. This is a bet on execution risk being overestimated.
So wrapping up, what does this all mean for the sector at large?
I mean, it means Coforge made a defining high-stakes bet on AI scale, period.
They took on the dilution, they took on the debt, all to leapfrog into that $2.5 billion tier.
And the next 6 months are going to be all about QIP execution and providing clarity on integration. That's it.
Which brings us to our final thought for you to consider.
Go for it.
Coforge was willing to use its own expensive stock as currency to buy another company at a steep 21 times EBITDA multiple. What does that desperate willingness signal about the true scarcity value of specialized AI talent across the entire IT sector right now?
That's the real question. Should investors start applying a higher AI multiple to any IT firm that makes a similar bold move? If the cost of entry into scalable AI services is just this much higher than we thought, does that force us to re-rate every player who makes a similar bet?
Something to think about. Consider the integration challenges, the pressure to deliver those margins, and the long-term impact this scale play will have on Coforge's peers. Thank you for joining us for this deep dive.